Hey everyone, and welcome. Today we're diving into two of the biggest names in the financial world, futures and options. Now, you might think they're pretty similar, right? I mean, they're both ways to trade on what an asset might be worth down the road. But trust me, at their core, they are fundamentally different animals. So let's get right into it and see what really makes them tick. So here's the big question. How do you bet on the future price of oil or gold or even the S&P 500 if you don't have a time machine? Well, that's the exact problem that both futures and options were invented to solve. They're basically contracts that let you speculate on or protect yourself against price swings that haven't even happened yet.
All right, first up, we've got futures. And if you want to understand a futures contract, you have to think of it as a rock-solid binding promise. It's like a handshake deal that you absolutely positively have to honor. No backing out.
The most important word on this slide, the one you really need to remember, is obligates. This is not a maybe, it's not a suggestion, it is a commitment set in stone. When you enter a futures contract, you are legally locked in. So if you buy a contract for crude oil, you are obligated to buy it at that agreed upon price when the time comes. And if you sell one, you're obligated to sell. It's a two-way street, a serious commitment on both sides.
So you might be wondering, how can I possibly afford to control, say, 100 barrels of oil? Well, the magic word here is leverage. See, with futures, you don't pay for the whole thing up front. Instead, you put down what's called a good faith deposit or initial margin. Think of it as a small down payment, maybe just a few percent of the contract's total value. But that small deposit lets you control a much, much larger position. And that magnifies everything, your potential gains and, just as important, your potential losses. And that incredible power of leverage brings us to this really important piece of wisdom from the futures guru Jack Schwager. Because the leverage is so high, managing your risk becomes everything. Futures are an incredibly powerful tool, for sure, but they demand serious discipline and a real understanding of the market. Success here isn't about one lucky shot. It's about having a solid, well-thought-out strategy.
Okay, let's totally switch gears now and talk about a completely different beast. If futures are all about obligation and promises, then options are all about, you guessed it, having options. It's about flexibility, it's about the power of choice. And this is the game changer right here. An options contract gives the person who buys it the right, but, and this is a huge but, not the obligation. This is the absolute core difference between the two. If you buy an option, you get to decide later whether you want to go through with the deal or not. The power is in your hands. Now, this choice comes in two main flavors. You've got a call option, which gives you the right to buy something at a set price. You'd grab a call if you think the price is going to shoot up. Then you have a put option, which gives you the right to sell at a set price. You'd buy a put if you think the price is about to take a nosedive. It's that simple. Calls for when you think prices are climbing, puts for when you think they're plunging. So, what's the cost for this amazing right to choose? Well, that cost is called the premium, and its price is cooked up from a few key ingredients. First, of course, is the asset's current price. Next up is time, and with options, time is literally money. An option that expires in 6 months is way more valuable than one that expires tomorrow, simply because there's more time for the price to move in your favor. And finally, there's volatility. The more an asset's price jumps around, the more valuable the option is because there's a higher chance it could make a huge move. Okay, so we've met our two contenders. In one corner, we have the binding promise. In the other, the flexible choice. Now it's time for the main event. Let's put them head-to-head and see exactly how they stack up. Let's break this down. First, the commitment. With futures, it's an obligation. You have to settle up. With options, for the buyer, it's a choice. You can walk away. Second, the upfront cost. For futures, you post a margin. That's a deposit you might get back. For options, you pay a premium. That's the price of buying the choice, and it's gone for good. And this all leads to the biggest difference of them all, your risk. This is so important to understand. Because a futures contract is an obligation, your potential loss is, in theory, unlimited. Let that sink in. If you promise to buy oil at $80 a barrel and it suddenly crashes to $40, you are still on the hook to buy it at $80. The market can move against you way beyond your initial deposit, and that can lead to some truly massive losses. But what about an options buyer? While their risk is perfectly defined and totally limited from the start, what's the absolute most you can possibly lose? It's the premium you paid for the contract. That's it. If the trade goes south, you can just let the option expire. You lose what you paid for it and not a penny more.
Your downside is completely capped. And that really brings us to the number one takeaway from all of this. Before you ever think about trading either of these, you have to know your risk. Understanding the tool you're using means understanding what you stand to lose before you ever put a single dollar on the line. So if you remember just one thing from today, please let it be this. Futures are about certainty and obligation. Options are about flexibility and choice. One is a promise that you absolutely must keep. The other is like a ticket that you can choose to use or just throw away.
And in the end, it all comes down to this one simple question. When you look at the future, are you so sure of what's going to happen that you're willing to make a binding promise? Or would you rather pay a little bit upfront to buy yourself the flexibility of choice? The answer to that really defines your whole approach to risk and opportunity.